If you're a self-employed business owner and you'd like to save taxes and or build wealth outside of your current business for your future retirement, you'll want to watch this video. A solo 401k is one of the most powerful tools available to self-employed business owners, not just because it helps you save taxes, but because it gives you options to build a large source of wealth outside of your business. You can save taxes now and reinvest back into your business and build income for the future, or you could build tax-free income outside of the business for your future. Today, we're going to walk you through both and help you understand which makes sense for you. The solo 401k is a self-employed retirement plan strategy. It's a powerful tool because it gives you flexibility. You can use it in two different ways or in a combination of both. You can use it for pre-tax to save taxes now, and of course, plow that back into your business to grow your business and that asset, or you can use it as a Roth, pay your taxes now, and it grows tax-free, and you get it out tax-free later. So the key question is, do you need cash flow today or tax-free income later? It can be both, and we can use these we can structure these to go back and forth. So why the pre-tax solo 401k works? Because you get lower taxes today. It improves your cash flow because the money you'd send to the IRS, you can plow back into your business. Um, and why the Roth works? You have no taxes on the growth. You have a tax-free income later. And over the long term, you'll accumulate more and be able to take more out. So the plan structure in a solo 401k, it can be you have employee contributions, those can be Roth or pre-tax, and then you have employer contributions, which is in the form of a profit sharing plan. Those are typically pre-tax or have been in the past, but with the changing tax laws, the new plans you can put those after tax into the profit sharing side. So the tax savings example, let's say you wanted to save 32,000 contribution a year, and that's basically this is a 55-year-old business owner. He's going to save for 10 years and then likely retire. But 32,000 is the max that they can contribute as an employee. So he this in this example contributes 32,000, uh, reduces his taxes with the 30% tax rate, so they'd save $9,600 this year in taxes. The 32,000 contribution should grow to 500,000 in 10 years, assuming they could get a 9% tax rate. Pretty aggressive, but the file we just worked on, they were very aggressive. So a 32 income pre-tax versus the Roth. So once you've saved this up, if you took 20,000 a year out, pre-tax, you would get 14,000 in net income per year. With the Roth, if you put 32,000 away, you could get 20,000 out without taxes. So the difference is 6,000 in tax savings difference per year as you contribute, and $180,000 tax savings over 30 years. So we have a maximum case because if you combine employer contributions and a profit sharing with employee plus employer, you put in $80,000, you'd save 24,000 in current taxes annually. That contribution would grow tax deferred for 10 years, and you'd have 1.2 million, assuming that 9% on average. At age 65, you could take out 48,000 in income. If it were the pre-tax account, your net income per year would be $33,600. If it were the Roth, you could take out 48,000 a year without paying taxes. Or you could, keep it in your account, reduce it to the 34,000, and just keep it in your savings, growing tax deferred. So the comparison tax savings over 10 years, the 32,000, you get $9,600 savings. So over 10 years, you're saving $96,000. For the $80,000 contribution, you're going to save $240,000 over the 10-year period. So Roth tax savings, you'll get no deduction for the next 10 years. The trade-off, you have no savings now, but it's tax-free later. Now watch this build up. So your 10-year account values, if they grow at 9%, and Dave Ramsey says 12, um, depending on your personality, 7 might be a more conservative, prudent growth rate. But anyway, 32,000 contribution grows to 500K, 80,000 to 1.2 million. That's the same regardless of which type of solo 401k plan you have. The income at age 65, and we're just using a 4% rule. That's kind of generic safe withdrawal rule. Pre-tax with the 32,000 case, you could take out 20,000 a year. $80,000 case, 48,000, and that would last at least 30 years. So your pre-tax solo 401k, the net income, you take out 32,000, or you put 32,000 in, take out 20,000 a year, you would net 14,000 after tax for 420,000 net. The $80,000 case study, you'd have 48,000 and you get 33.6 per year, or 1 million out over 30 years. Now the Roth, so you're giving up the tax break now, but you'd have 20,000 a year for 30 years and be tax free. So you'd net 600,000. And if you maxed out the solo 401k, you get 48,000 a year at 4%, and you take out $1.4 million tax free. So the lifetime difference with the Roth, you get 180,000 more. In the max case, you get $432,000 more net of taxes with the Roth. Same investment, different tax outcome. The big picture, you could save 96,000 to 240,000 now. With the Roth, you would gain 180,000, 432,000 later. So basically, the decision is the timing of taxes. Also, if you get the tax deduction and you put it back in your business, how much more does that make your business worth? So it's not an easy decision, and you can rotate these year to year depending on, hey, if you have a lot of expenses in your buildings, you don't in your business, you don't need a write off this year. You can put those in a Roth those years, and then if in the years that you need a tax break, you can do pre-tax contributions and or profit sharing. You can switch it back and forth. So the key takeaway, solo 401k can give you both options. Pre-tax or cash flow, Roth for long-term wealth. And long-term wealth, that goes along for your estate. So if you have, non-spouse beneficiaries with with the pre-tax, you're going to require minimum distributions eventually, age 73. If that goes to a non-spouse beneficiary, um, they will have to take that out over a 10-year period. So if they're in their peak earnings years, that might really hurt their tax situation. With a Roth, they still have to take it out over 10 years, but there are no tax ramifications. Here's just a chart of the tax savings. As you can see, you know, and the annual income. So some advanced options with the solo 401k. You can invest in private investments, real estate, and it has loan features. So the big picture, there's not one best strategy. You can use both pre-tax, after-tax for wealth building. So the next videos we'll have coming up, we're going to add um, if you put a spouse in your business with his or her contributions, how that can build family wealth, advanced contributions. That's just using cash benefit and other types of retirement plans, investment options, pretty much anything in a brokerage account, but you can also buy real estate notes, uh, commercial real estate, um, private businesses. But in those private type investments, you want to be very aware of prohibited practices and self-dealing, conflict of interest, because you can't use your retirement plan to invest, in things that you're already invested in. That'll be in a different video. Other videos, are you missing out on R&D credits? 85% of the businesses who are entitled to tax credits are not requesting them and getting them. They're not fulfilling their tax benefits. Cost segregation. We bring this up if you've bought a building, in the last few years, um, with the new tax laws, you can accelerate that depreciation and save a lot of money quickly. And our point will be is, there's a lot of internet talk that cost segregation is only good for a building worth 2 million or more. The uh, the report costs $10,000 to $30,000. Uh, we have a cost segregation professional, national company. Their reports start at like $3,000. So if you have a $500,000 building, you might be able to save, 10 grand, 60 grand, 100 grand in taxes for $3,000 to $4,000, which is pretty much the price of an appraisal. So we'll cover that in a future video. So if you'd like to start saving taxes and building wealth, or you want a second opinion on what you have going on right now, uh, give us a call or go to our website, foresightwealthadvisory.com. Schedule a strategy session. We'll show you on a whiteboard how some of our tax ideas or even estate planning ideas, how they can actually help you. And then, so you can decide for yourself, hey, is it worth my time to hire a professional to help us build our wealth? Thank you very much. This has been Mike Wright with Foresight Wealth Advisory. Have a great day.